Hi, I'm Ben Graham. This is our first of several lectures on foreign investment, and this is kind of the second major module in this international political economy course, right? So if you recall, we started with supply and demand, we started with comparative advantage, talked about the tools with which countries can restrict trade if they don't want to open up, and we talked about sort of mapping uh, the different economic interests of various interest groups with respect to free trade and trade protection. And we got into a little bit of this stuff about foreign pressure to open up markets, right? And we talked about the Washington Consensus, right? But the Washington Consensus involves a lot more than just trade, right? It's a lot about opening up to foreign capital, right? And so this gets to be, before we can talk about all the big picture political things we want to, we need another round or two of economic fundamentals. So we're going to do a foreign investment piece next. We're going to talk about money and finance and exchange rates. And then we'll talk about foreign aid and migration, right? So we're moving through and we're allowing ourselves to discuss, the international politics of all this in a progressively holistic way, right? Not just the trade, but also the finance, but also the exchange rates, but also the aid, right? Get it all in there together. All right. So to approach this analytically, we want to start to split up foreign investment into different baskets so we can talk about how different types of foreign investment function differently, both economically and politically. So let's start with foreign direct investment. And this is where the foreign investor at least partially controls the enterprise they're investing in. And empirically, we sort of have about a 10% ownership stake cutoff in terms of what we consider foreign investment. But conceptually, it's about, are you playing a role in running the enterprise in which you're investing? Kind of the archetypal foreign direct investment is a multinational firm that opens up its own affiliate in another country. And it may control that affiliate completely if it's a wholly owned subsidiary, or it may have some sort of a joint venture partnership with a domestic company in that country in which it's investing, right? So it might own all of or part of the overseas enterprise. Okay. And then with portfolio investment, you're still investing in an enterprise that's operating overseas, but you only own part of it, or you lend it money. So either you own an equity stake, that's a stock, right? Or you own debt, which is a bond. Right? So a bond is just a loan from a company to a investor. And this can be, if you haven't run across bonds before in your life, the language around it is a little bit tricky, because when you buy a bond, you are lending somebody money. And when you sell a bond, you are borrowing money. And that can get a little bit tricky to wrap your head around. And then we also have bank loans in this portfolio investment basket. All right. Then the last basket that sometimes this gets lumped in with portfolio investment, but we can also talk about sovereign debt, right? Which is when the government sells a bond, like a US Treasury bill, a savings bond, right? That's the US borrowing money. And the US borrows money from individuals, but sometimes companies own government debt, and sometimes foreign governments own government debt. You have sovereign to sovereign lending. Like the Chinese government owns a lot of US Treasury bills, meaning that the Chinese government has loaned the American government a lot of money, right? Okay. So those are sort of three categories, but we want to think about substantively, how are different types of investment different? And so we're going to talk about hot capital versus cold capital, and we'll talk about, within the foreign direct investment category, we'll talk about vertical diversification of multinational firms and horizontal diversification. So we're kind of going to continue with this theme of kind of splitting up capital, foreign capital, into different baskets and talking about how they behave. So hot capital is essentially very liquid capital, meaning that you can buy and sell it easily. If there's lots of buyers and sellers in a market, then we call that market liquid, right? It's easy. If you want to buy, it's easy to find a seller. If you want to sell, it's easy to find a buyer. And so that means that if you want to pull out, if you want to sell your stock, or if you want to get paid back on your loan, you want to sell your bond off to somebody else, then you can do that quickly because the market's liquid. Right. And so this leads to quite a bit of volatility. If all of the foreign investment, if you've got a whole lot of foreign investment in your country, and if it's all hot capital, that means that as soon as you get a little bit of a downturn economically, all that capital can go whooshing out the door overnight, right? We can sometimes see stock markets that crash 50% of their value, 60% of their value, in the span of a few weeks. And we'll have flash crashes in markets where they go down 10, 15% in a single day. right? So this can happen to you really quickly. So it's a small downturn, suddenly becomes a big downturn, right? And so these are things like stocks, right, which generally a very liquid market. You can sell those overnight. Short-term loans are the other big piece here. So the thing about something like the U.S. government debt, the U.S. government has huge, huge debt, and we keep rolling it over. And if a lot of your debt is very long-term, you know, a lot of people own 10-year U.S. Treasury bonds, right? Well, that means that every year you're only rolling over 10% of your debt, or every quarter you only have to roll over, you know, 2.5% of your debt if it was all denominated in 10-year T-bills, right? So that means that if you have a bit of a recession and things are getting a little bit risky, you have to pay a little bit higher interest rate for a while. You only have to pay that higher interest rate on that 2.5% of that debt that you have to roll over this quarter, right? But let's now imagine a world where all of your debt is in 6-month increments. Now you have to roll over all your debt, which means you have to find a new buyer for all of your debt every 6 months, right? Because in order to pay back the last loan, you have to take out the new loan, right? Instead of having to take out that new loan once every 10 years, you have to take out that new loan now every 6 months, which means every 3 months you're rolling over half of it, right? So that means if you've got this little bit of a recession this quarter and risk is higher right now, you have to pay that higher interest rate, not on 2.5% of your debt, which would be the case if you had these 10-year loans, but on half of your debt, right? So suddenly this small recession becomes a big recession because your debt's gotten really expensive, that risk snowballs. Okay, so this hot capital is super risky. How do hot capital investors make money, right? Like what's on it, what's in it from the investor side, right? So the major thing here is we can think about that there are basic sort of toy model reasons for capital to flow from where it's abundant to where it's scarce. So if you've got a whole bunch of folks saving money, say in the United States, you've got a capital abundant economy, right? Then you have a supply of capital that's quite high, right? And where the supply is high, price is going to be pretty low. You might have another country where there's not a lot of wealth, there's not a lot of savings, and the supply of capital is pretty low. Well, interest rates there are going to be really very high, right? So capital is going to tend to flow, and we'll see in the next lecture that this doesn't happen in practice very much, that the capital flows actually go the other way. But this pressure, sort of this toy model economic pressure, is going to push capital from where it's abundant to where it's scarce, right? Where the interest rate is low and I'm not making much money on my capital to where the interest rate is high and I'm getting a higher price for my capital, right? So one of the reasons why somebody would say why an American would buy a Brazilian stock or something like that instead of just an American stock is that they might expect the return to be higher. Why would you lend money? Why would you buy a bond in a Brazilian firm or an Argentine firm or a South African firm? Right? Well, you might expect that interest rate is going to be higher. And it turns out that those interest rates are higher, in part because capital is more scarce in those places, in part because the risk is higher. So we'll talk about that risk premium as we're moving forward in these lectures. But so one reason you go and you lend money overseas is to get a higher interest rate, right? And the other reason is you might be engaging in currency speculation. So you have money that's sitting in dollars and you're like, well, I don't think the dollar is going to appreciate in value much, or it might even depreciate in value over time. I'm going to take my savings that I have in dollars, I'm going to convert them into Argentine pesos or into Russian rubles or something like that, and invest in the Russian stock market or the Brazilian stock market or the Argentine stock market, something like that, right? Or lend money to an Argentine firm or a Russian firm. And then if that, say I made a loan in rubles and I'm going to get paid back in rubles, if the Russian ruble appreciates relative to the dollar, I'm going to get my interest rate on that loan as well as the gains from the value of the Russian ruble increasing. So I'm both getting an interest rate and I'm speculating on any currency changes that might happen, sort of dollar vis-a-vis ruble or dollar vis-a-vis peso, something like that. Okay. So there's hot capital. There's also cold capital. Right? And here we're really talking about foreign direct investment. And again, the archetype here is that multinational firm opening up an affiliate overseas, right? Where the investor actually controls, or at least partially controls, the business in question. This tends to be a longer term investment because this isn't a very liquid market, right? If I take all my retirement savings and use it to buy Apple stock, I still own just a tiny sliver of Apple. And nominally speaking, I have some voting rights in the shareholder meeting, but I own such a small amount of stock. I have such a small voting right that I don't have any say over when the next iPhone gets released, right? Like that's not, I don't have any say in who the next board member is. Like I have no control of what's going on. But it's also very easy for me to find somebody to buy my Apple stock. There's lots of other investors who can afford to buy that stake, right? And so it's a very liquid market. On the other hand, if I own 60% of Apple, and I have like this controlling interest in Apple, and I'm appointing board members and making all these decisions about who's doing what, it's also going to be much harder for me to sell my stake, because now we're talking about $600 billion worth of the company. So it's a very large chunk of change, but also whoever takes it over has to have the confidence that they can run it, and they have to want to run the company. They have to think they have the ability to guide that firm in a way that will make money and make their investment worthwhile. It's a much smaller pool of potential investors, right? So so these tend to be longer term investments. You don't take a controlling stake in a company. You don't become part of the management of that company and then relinquish that again quickly overnight, right? It tends to be a longer term investment. Okay. However, the long-term nature of the investment, and particularly that difficulty of finding other buyers, makes firms particularly vulnerable to a lot of political risks, right? Over time, changes in the politics of the country you invested in that might harm the value of your investment. And we'll talk in particular about a phenomenon called the obsolescing bargain, which is sort of coming up. We'll run through in some detail how different types of political risk work, and we'll do that in the second lecture in this little module. So why are firms engaging in foreign direct investment? So the same reasons obtain of sort of taking capital from where it's abundant to where it's scarce to get a higher return. But you can also think about it sort of in a factors of production sense, right? Where we're taking a factor of production capital from where it's abundant to where it's scarce. But we're also bringing that capital to pair it with labor and land, right? That might be scarce in the country where the capital is residing. So an American investor, an American multinational could build the factory in the United States, right? But labor is really expensive there. So I'm going to go build my factory in Bangladesh where it's cheaper, or Indonesia where it's cheaper, or Mexico where it's cheaper, right? Or I might go, if I'm the Dole Fruit Company, I might go and buy some land in a tropical country where I can grow pineapple more efficiently than if I'm trying to buy it in the United States or trying to grow it in the United States, right? So there, where I might be seeking particular types of natural resources, that sort of thing. The other thing I might be seeking is markets, right? So we might be building GM might be building a car factory, or Tesla is famously building a big car factory in China right now, in part to access some cheaper labor within China, and particularly cheaper labor that's going to make the parts that then feed into those cars, as well as the actual assembly of the cars themselves, having cheaper labor for that. But they really want to access the Chinese market too in the long run, right? And GM, most of their growth now is in China, right? So they're trying to access the Chinese market as well as access the labor that's in China when they make those investments. Okay. There's one other way in this video I want to sort of split up capital and then we'll sort of cut over to talking about political risk and risk premia and that sort of thing. And I want to talk about horizontal diversification versus vertical diversification. And vertical diversification is when, so a lot of products have this long supply chain where there's many different steps in the production process. And with vertical diversification, you're moving different steps of that production process to different countries, but you're keeping them all within the same firm. Right. So the Firestone Rubber Company was one of, a fairly early pioneer in doing this. They owned a lot of rubber plantations, particularly in sub-Saharan Africa, right? And they were actually very involved in politics in these places, right? They were very large landowners, but they owned the rubber plantation, but they also owned the tire. So they owned the plantation, tapped the rubber, turn that raw kind of material coming out of the rubber trees into rubber that they could then turn into tires. And then they even own like all these automotive stores where they're selling the tires and fixing cars and doing all that kind of stuff. So multiple different production processes, all within the same company, and different production processes taking place in different countries, right? So you're achieving big economies of scale. These rubber plantations are phenomenally large. So it's not like everywhere that Firestone sells tires, they have a rubber plantation in each of those countries, right? They've got a few enormous rubber plantations and then a few enormous tire factories, right? And then a bunch of different small sort of sales outlets. Right? So you got big economies of scale at different stages of this production process. And they're taking advantage of international specialization. They're growing the rubber where it's cheapest to grow the rubber. They're making the tires where it's cheapest to make the tires. And they're selling the tires where it's most profitable to sell the tires. So they're doing different things in different places. Same thing with the Dole Fruit Company. They don't just own the plantations growing the bananas and growing the pineapples. They also own the canneries where you're doing this stuff, right? So they own different stages of the production process located in different countries. They're often growing, growing the pineapple in one country and canning it in another, but they're vertical within the same company. So vertical integration is multiple steps of the production process, each taking place often in different countries, but always within the same company. Horizontal diversification is where a multinational firm is, again, doing things in different countries, but doing the same thing in each country, right? So market-seeking FDI often takes this horizontal form, right? Where you're producing the same good or service in several locations, but you're either avoiding tariffs and shipping costs, like that's an important reason to do this. So, you could bottle some Coke in this country, in the United States and ship it to Canada, except if you're doing that, then you might have to pay some tariffs when you ship it into Canada. And also, Coke is really heavy and liquids are really heavy. You have to then pay these shipping costs. So you might want to actually bottle it closer if shipping costs are high, like liquids. Or sometimes you want to tailor it to local taste, right? So famously with Coke, right, Coke bottled in Mexico is using sugar as opposed to high fructose corn syrup on the stuff bottled in the United States. So you can actually have a different recipe for Coke in different places. So Coca-Cola is an example of horizontal diversification, although actually, so technically Coke is licensing with a lot of these bottlers, and we'll kind of talk about that distinction in a little bit. So Coke actually doesn't even necessarily own outright a lot of the bottling facilities that are located around the world. But the Coca-Cola bottling plant in Inner Mongolia is doing the same set of processes that's going on in the Coca-Cola plant in Mexico or the Coca-Cola plant in the United States. Same thing with like a Starbucks, different Starbucks locations, different places. Now, Starbucks also does some vertical integration where they own sort of roasting facilities. I don't think they own any of their own sort of plantations where coffee is grown. I think they source those, but then they do their own roasting and then they sell. But you can see, the Starbucks that's in France and that's in Germany and that's in China are all doing the same set of processes, right? Sometimes with products then customized to the local market as well. Okay. And so the last slide that I want to kind of show in this particular lecture before we move on to the next one, sort of to talk about the Lucas paradox. So the Lucas paradox is this idea that the simple toy economic models are going to predict that capital is going to flow from rich countries to poor countries, from places that are capital abundant to capital scarce, right? Places with low interest rates to places with high interest rates. That's how capital kind of should move in these simple economic models. But instead, if we look at global capital flows, we actually see on net, we see the reverse. It's not that there isn't any capital flowing from rich countries to poor countries. We also see a lot of capital flowing from poor countries to rich countries. And if you look at like where most of the capital from the United States goes, like where is most of US outward FDI, most of that foreign direct investment, that FDI is in Western Europe, right? A lot of it's in Canada, a lot of it's in Mexico, but it's going to other rich countries. It's not going to extremely poor countries nearly as much, right? So that's the Lucas paradox, is that we see a lot of capital flowing from poor countries to rich countries. So if you have some capital and you're sitting there in Ethiopia or you're sitting there in Peru, a lot of times the investment you're making is you're investing in the United States or you're investing in Western Europe, right? You're buying, shares of American companies on the stock exchange, rather than investing locally or investing in other poor countries. Okay, so why does that occur? Why don't you get all this capital flowing from where it's abundant to where it's scarce? And the answer sort of very concisely is that politics matters, right? So we'll be talking about political risk, we'll be talking about these sorts of things, but the toy economic models aren't enough. We need the politics, and that's what we'll be doing in the next lecture.